Good afternoon, everybody. Welcome to our third session in a series on what board directors who serve on banks and insurance companies need to know in respect of climate change. This event is hosted by Chapter Zero and HSBC. I want to thank HSBC for their fantastic help in designing this program. And pulling together such a stellar lineup of speakers. Next slide, please. Let me then quickly run you through Chapter Zero for those of you who are here for the first time, and apologies to those who heard this before. Chapter Zero is an initiative that was launched under the auspices of the World Economic Forum, and our goal is to bring together non-executive directors of company boards to give them the specialist skills in respect of climate change and also access to one another and access to experts, such as the people we're about to hear today, so that they can go back into their boards and be advocates for a proactive climate transition and climate adaptation strategy. We are present now in 18 countries. We're at various stages of maturity. So the UK chapter, which you see featured here on this slide, is by far and away the largest in terms of numbers of members and in terms of the activities. But we have chapters running all the way from Malaysia through Russia, several countries in Europe, and we now cover North and Central and South America. And I want to particularly thank, again, HSBC for helping us set up chapters in Mexico, Singapore, and Hong Kong. So we are really excited about the progress and the positive reception that we've been getting from directors around the world who understand that there is something that they need to master and are very eager to acquire a brand new set of skills that don't exist. I mean, there's just no ready-made manual out there, and so we're having to create it, and this webinar series is one such example. Now, as I said earlier, this is focused specifically on directors who serve on banks and insurance company boards. Most of you come from those very companies, and the reason for that is this is a response to our members. We had a significant number of board directors who were on financial services companies and who rightly complained that we were overly focused on industrial companies, particularly the large emitters or the companies that are very visibly exposed to the effects of climate change, such as companies in the agri-food industry or tourism, for example. And in fact, as you're going to hear today, and those of you who've attended the two previous sessions have heard, the financial sector is very much on the front line of the climate transformation. One, because they are a massive lever of change. What banks and insurance companies do with their funding decisions and their underwriting decisions has a major multiplier effect in terms of what their non-financial clients then choose to do in terms of what they invest, what they prioritize, etc. And secondly, because the regulatory environment is pushing them to do that. Today's session is going to turn to something different. I'm going to hand over to Daniel, who's going to walk you through that. But before I do, I just wanted to say one last thing. We've been taking feedback from you, and we have been adapting these to make sure that we capture your concerns. The number one concern that you've expressed is the fact that you want to know what questions to ask of your managers. What should I ask? What do I need to know? What constitutes an acceptable answer? How do I engage with my staff to ensure that we are really doing the right thing in terms of risk, in terms of scenarios, in terms of disclosure, in terms of compliance, in terms of public policy advocacy, etc. So our hope here today is that we are going to help you come out of this knowing what questions you need to ask when you turn up in your board or your committee meetings tomorrow. And by all means, please continue to send us your feedback so that we can continue to make these perfectly tailored to the needs of non-executive directors. And with that, I will hand over to Daniel. Thank you very much.
Karina, thank you, and good morning, good afternoon, good evening to everyone, wherever you are, and welcome back for those of you that are joining us again. As you see on the slide, this is part of a 5-part series In the first two sessions, we looked at the broader picture of what's happening on climate risk and regulation, and we then heard from policymakers and regulators where this is going. So I think those of you that have joined us before should all be aware now that the regulatory development, the investor development, and the broader stakeholder side for financial institutions is moving rapidly. You will see this every day. We're now going deeper into some of the sub-elements. And normally when we think about the impact of climate change on financial institutions, people think about four big dimensions. One is governance, and that's obviously the overall discussion that we're having here today. The second one is scenario analysis. The third one is how do we integrate climate risk into risk management? And the fourth one is disclosure. And that's what we're covering today. We want to talk about three things in this session. We will talk about why disclosure is so important. We want to talk about what good disclosure looks like. And then we want to discuss how our investors, so investors and bank and insurance companies, are using disclosure to drive investment decisions. And so on that basis, I think we have three excellent speakers. If we just go to the next slide. We have Sarah Barker, who joins us from Melbourne, actually. She just said she's now smelling spring in Melbourne, where she's a lawyer at MinterEllison, one of the leading climate litigators. And you will hear today why litigation risk actually is a increasing concern for companies and individuals on boards. We then have Paul Simpson, who's the CEO of CDP. Many of you will know that CDP is the leading disclosure framework on environmental matters across industries, but also for the financial services sector. And then we have Meryam from Legal & General. She leads the full integration of ESG into investment decisions, but also the product development around ESG. We've asked each of the speakers to give about 15 minutes overview of the topic. So Sarah is doing the why does it matter. Paul will give us an overview what good disclosure looks like, and Meryam obviously how investors will look at this. We will then in the end have time for Q&A. I will moderate the process, and please put your questions into the chat function whenever you feel they're coming up, and we'll consolidate them at the end. As every time, slides will be available at the end on the Chapter Zero website, and we're recording the session. I know many of you are sharing this afterwards, and we will do the same with this session. Having said that, thank you everyone for joining. Thank you to the three speakers, and Sarah, over to you.
Thank you so much, Daniel. I'm just going to share my screen with everyone. There we go. I have the honour of explaining to a bunch of directors why climate-related governance is such an important issue for you. And I suppose it can be summed up in the maxim that nothing focuses the mind like the spectre of personal liability. When I first started as moving across from being an antitrust lawyer to being a full-time climate risk governance lawyer, the first question I was always asked by in-house counsel and by directors themselves is, show me the case. Show me the case rather than the theory. So today I'm going to talk you through exactly that. We now have a significant uptick in trends associated with the number of climate-related claims filed, not only against corporations, but their directors. And this is in jurisdictions, of course, the US, where you would expect being a very litigious jurisdiction, but not exclusively. Increasingly, we're seeing claims being filed in other jurisdictions, both civil and common law, from Australia to the United Kingdom, to Canada, to South Africa, to the EU. I also want to impress that this is not a matter of litigation that is arising due to a regulatory breach. It's not litigation arising because a large emitter has failed to comply with their obligations to mitigate their emissions, for example. And in fact, there's almost an inverse relationship between the volume of emissions-related legislation in a jurisdiction, as you can see there, and the frequency with which claims are filed against companies and directors. So today I just wanted to talk you through 3 things. First of all, litigation against your institutions. Secondly, against institutional directors. And finally, trends in litigation against borrowers and investees, which of course can have secondary and tertiary flow-through impacts for financial institutions and for financial stability within an economy more broadly. So litigation as it manifests against financial institutions and their directors is primarily a function of economic transition risks associated with climate change, although of course it can also manifest in the physical risks associated with climate change. Here I've got a copy of a report that we originally did for the European Commission back in 2017, when we actually looked at the role of litigation as a material driver and or consequence of the transition to a low carbon economy in Europe. And a number of the categories that we analysed there squarely related to exposure to claims by financial institutions and their directors for a failure to adapt to the foreseeable impacts of the transition to a low carbon economy. And here very much we're looking at claims for misleading disclosure or securities fraud, as it's called in some jurisdictions, but also a breach of a director's duty of due care and diligence. Because one of the corollaries of the shift of climate change from being an environmental lefty hippie greenie issue to one that presents material financial risks within mainstream investment horizons is that it does open up the entire suite of commercial litigation and undeniably renders climate change an issue that must be considered as a foreseeable financial risk consistent with the best interests of an organisation. Now, since that time, these claims are no longer theoretical. So increasingly, we are seeing live examples of cases both against institutions themselves and against their directors and officers. So here I've got an example of a case filing against a $50 billion Australian, so about $40 billion US / Euro pension fund, Rest Super. A beneficiary of that fund has brought a claim against the trustee, alleging in essence that the trustee has breached its duty of due care and diligence by failing to integrate climate-related financial risks into their investment strategy on behalf of that beneficiary. Now, this case is notable because it will run. It is set down to run to trial this November. It was certainly the first of its kind around the world, and it sent reverberations amongst the pension fund directorship community here in Australia, of which I am one, certainly when it was filed. More than that, and in addition to that, the same law firm that is behind the Rest filing has more recently filed a claim in relation to sovereign bonds issued by the Commonwealth Government here in Australia. In late July, a claim was issued that alleges that the Commonwealth Government acted in a way that was misleading or deceptive by failing to disclose climate-related financial risks in their investor statements issued in relation to sovereign bonds. Now, it's very interesting that this related to disclosures for vanilla bonds. It wasn't the case that the government had issued a green bond and an allegation of greenwashing was levelled at it. This is squarely the issue of a vanilla instrument and an allegation made that given the materiality of climate-related financial risk to a sovereign, that the elements of the impact of climate change should have been disclosed to investors in that case. Interestingly, this was actually an argument that we first saw being run by the carbon majors as part of the series of cases that's currently ongoing in the US, where a number of municipalities are running claims against the carbon majors, seeking damages for the cities having to adapt to the physical impacts associated with climate change. In one of the cases associated with that series, an argument was actually run by the carbon majors that if climate change was such a material risk for the municipalities that were suing it, then they would have themselves needed to disclose climate-related financial risks in their own municipal bond disclosure documents. So it's an additional element that needs to be considered now for any financial institution issuing any kind of debt instrument. How robust are our procedures for the information gathering, verification and disclosure of climate-related financial risks, and how they may impact on the financial security associated with the bond. One more interesting observation in relation to this case, particularly in relation to directors. In addition to the claim that the Commonwealth Government had acted in a misleading manner, the plaintiffs have also joined two officers, two individuals associated with the bond issue, the Secretary of the Treasury and the CEO of the Australian Office of Financial Management, alleging that as officers responsible for the organisations making the bond issue, that they breached their duties of due care and diligence in allowing the Commonwealth to issue investor statements that were misleading. So the bar on this just keeps rising for directors. If we're looking at, well, what does due care and diligence mean for us? What do we need to do? From a very first principles basis, we can think about, well, we're tested against or tested to the standard of a reasonable director. What would a reasonable director do or have done in similar circumstances? It's very important, though, to note that the courts in recent times have expected far higher standards of professionalism and diligence from directors in reaching that standard of care. And really, if you think about, well, what is a reasonable director? What do they hold themselves out to be expert in? It really is risk management, strategy, and governance. So the question needs to be asked, what would a reasonable manager of risk and strategy and governance have done in relation to climate change in this circumstance? It's also very important to note that by the standard of a reasonable director, we don't mean the standard of care of an average director. The reasonable director is often held to a standard that's, in hindsight, more akin to standards of best practice than average. The question for us now in a climate context is, at what point does the standard of care actually require directors to ensure that their entities are complying with the TCFD? At what point does the standard of care demand governance that at least considers the trajectory of a company on a net zero strategic pathway? Now, these are live questions for the law at the moment, and I should note that the law is itself not concerned to require a particular outcome of boards. It's really concerned with the robustness of the decision making that sits underneath the decision. But nevertheless, it does remain a live issue for us as directors. At what point will the law oblige us to be considering whether or not we require a net zero strategy in order to be discharging our obligations to pursue the best interests, best financial interest of our company? The last thing that I flagged was the potential for litigation against borrowers and investees. Here I'm going to point to a recent report by the Commonwealth Climate and Law Initiative, for full disclosure of which I am a director, in which we looked at a related question on the different categories of liability exposure for financial institutions associated with biodiversity loss and ecosystem services. And you can see there that the categories of litigation that are relevant to potentially your borrowers or investee companies, and therefore that might impact on the financial stability of an institution itself, are very diverse across physical ecosystem impacts, transition risks, economic transition risks, and also in the category of misrepresentation. So given the time available tonight, I would, or this morning, wherever you're located, it's 10:30 at night for me, I would commend that report to you. In terms of examples of where we're starting to see those claims really starting to hit home, I think there is no better example than the series of cases we're seeing coming out of the UK, the EU, and the US in relation to judicial appeals against development approval decisions. So there've been a series of cases in relation to airport third runways, for example, in relation to motorways, and in New York in relation to gas pipelines, where the primary consideration was whether or not the decision maker had actually turned their mind to whether or not the development approval was consistent with the jurisdiction's net zero emissions target. So in the case of the Heathrow third runway, for example, the government's approval to allow that runway to go ahead was held to be beyond power, ultra vires, because of the fact that they had not reconciled the potential for that project, if approved, to be consistent with the net zero emissions target, as it was then prior to their law in place in the UK. So it's another layer of consideration that lenders now need to go through when considering the bankability, so to speak, of a project. Now, picking up on Karina's comments at the start of the session around the concern of members to ensure that they know what questions to ask of management, I will leave you with a set of questions for you to take away to be asking management in relation to your oversight of how well management is assessing and assuring exposures to climate-related financial risks, procedures for disclosures, and another issue that is material that we haven't had time to touch on tonight, which is contractual risk management and procurement. So I will stop sharing there and hand back to Daniel, or am I handing directly over to Paul?
Yeah, thank you, Sarah. Maybe I'll pick up one question that came through because it's so specific to you. The question is, how many of the filings actually resulted so far in penalties versus have been dismissed? I know we're very early in this discussion, but do you have a sense of sort of outcomes?
Yes, there has only been one case so far against a director, and not of a bank, of an oil major in the United States, where the finding has been that the director is not guilty. Every other case remains on foot or has been settled in advance of going to trial. So I certainly wouldn't take the absence of a judgment that specifies at this stage that a director has acted in breach of their duty of due care and diligence, or has acted in a way that constitutes security fraud to be evidence of the fact that this is not a live risk, because there are dozens of cases that remain on foot. And of course, most of these kinds of claims, particularly shareholder class actions, will settle prior to reaching trial in any event.
And one other question from me, I guess a number of directors and companies will question when asked themselves, is no disclosure better than poor disclosure, or is actually disclosing the right answer and then I evolve? But I think as soon as you obviously start to publish, you make yourself a lot more attackable.
If I had $1 for every time I was asked that question, Daniel, I would be a very rich lady. In relation to climate change, like no other area, there is a need for fulsome disclosure, because by remaining silent in relation to the climate-related financial risks that impact on your institution, what are you representing? You're representing either that it's not material for you, A, or B, that you have analysed the risk thoroughly and that you have concluded that it doesn't warrant disclosure. Now, either of those cases is going to be highly unlikely for a financial institution in a modern economy. And so it's actually less of a risk in this case for directors to ensure that their organisations are disclosing, and particularly publishing stress testing and scenario analysis with regard to the TCFD framework. And one additional issue we haven't had time to talk about tonight is, of course, the increasing noises from accounting standard setting boards indicating that that analysis should also be integrated and applied across into the accounting estimates in the balance sheet. So I would definitely say no disclosure is a huge risk, and fulsome disclosure is actually lower risk than you may anticipate, because investors understand these risks anyway. So you're not telling them anything that they don't know.
Sarah, thank you very much, and I think a great pass on to Paul, who really is the man to tell us what good disclosure looks like, and how a director should think about this. Again, Paul, I think the main question from members on this call is how do you question your management team? What questions should you ask in the boardroom?
Yeah, thanks, Daniel and Sarah, and great to be here with you today. And thanks to HSBC and Chapter Zero for inviting me. Stephanie, I think you're going to put my slides on the screen.
Yeah, if you can just give me a minute or so, Paul. We'll get
no, that's fine. I'll carry on, but some of the slides will be helpful. So, as Daniel said, I'm going to talk really about the importance and the value of disclosure, what good disclosure looks like, what is expected of your companies, and what is expected of you as board members of banks and insurance companies. I'm going to start with a provocation. I think you've already had a great one from Sarah, but that you wouldn't oversee or govern a company without good financial information and disclosure. It's not questionable. As a board, you have to have the right, not all, not too much detail, but really good financial information, and your company must be disclosing well on that. Anything else would be unacceptable. And I think we are now in the year 2000 becoming, or really in a similar place, that you can't govern a company without climate data and without your company disclosing, exactly as Sarah has said. And obviously, you know, you'll all be aware, I'm sure that's why you're on this call, the issue of climate change and other environmental issues has become very mainstream. You know, some 20 years ago when we started CDP, they weren't in the Financial Times and Economist every day and every week, and today they are. And for you, it's, you know, for financial institutions, banks and insurance companies, it is very much actually about what you're financing. So we get good disclosures on what, you know, the operations of companies, which if you're an oil and gas company or mining company, the emissions from the operations are really where to focus. If you're an auto company, it's the emissions from the use of the vehicles. But as a financial institution, it's what are you financing or enabling to happen through your products and services, where the primary risk is, both financially but also reputationally. And I'll come a bit more onto this shortly. And I will end with some questions I think you should be asking your managers. So if we can go to the next slide, please. So I run something called CDP, formerly the Carbon Disclosure Project. We're a global non-profit organization founded in the year 2000. We really work with companies, investors, cities to encourage the measurement and disclosure of climate change and other environmental issues. And since 2002, we work with institutional investors. Today, 515, it's on the slide, investors with more than $100 trillion of assets under management. There's some double counting in there, we've tried to remove it. And through CDP, they ask for large listed companies to disclose on climate and the environment. We also have a program where large companies like Walmart and Unilever use our platform to ask their suppliers to disclose. And those large companies have more than $4 trillion annual procurement spend. Perhaps most importantly, last year, 8,400 companies disclosed through CDP on climate change, representing more than 50% of global market capitalization. We also have 920 cities and states and regions who disclose. Next slide, please, Stephanie, which really takes me to the fact that climate disclosure, environmental disclosure has become the norm. This chart shows disclosure through CDP over the last 17 years, and we've seen a 36-fold increase in climate disclosure since 2003, as I said, to these 8,400 companies. So I would argue, and I think it's very clear that this is no longer something that is sort of nice to do or you should do perhaps, but it really is expected by the investors. You're obviously representing financial services companies, but it's also expected of you and your customers, expected by society. And it's really, and I'll come on to this more, something that's becoming required. We heard about this from Sarah already, by regulation and by accounting standards. Next slide, please. Now, in the last 5 years, the biggest development on climate disclosure has been the Task Force on Climate-Related Financial Disclosures. Many acronyms in the world of climate change, just as there are as investment. So the TCFD. And the TCFD was established at the request of the G20 finance ministers under the auspices of the Financial Stability Board. And Mark Carney, who was then Governor of the Bank of England, was chair of the TCFD, and Mike Bloomberg then became co-chair later. So the lens of this was looking at what does climate change, what are the risks that climate change presents to financial stability, obviously fundamental for financial institutions to consider that. And the TCFD then in 2017 provided a set of recommendations on what good climate disclosure looks like. They cover 4 key areas, four groups really of information. Firstly, on governance. How is your company governing climate risk and opportunity and the management of that? Secondly, on the strategy. How is your strategy responding to climate change? The world is changing, climate change is becoming a greater risk and opportunity. How is your strategy addressing that? Thirdly, risk management, very important for you as financial services companies. What risk management approaches do you have in place with the changing landscape of climate risk, very much as Sarah has talked about? And finally, that to be robust in disclosure, you must have really clear and strong metrics and targets. And there's some very good examples of those metrics and targets that I'll touch on in a moment. And I'll just say that I think from my perspective, having worked on climate disclosure for 19 years now, that the TCFD brought 3 real innovations to what should happen in disclosure. They very clearly recommend that climate disclosure should be integrated into your mainstream report if there is deemed to be serious or material risk. Secondly, they say that institutional investors, banks, insurance companies should be disclosing, as well as corporations who have very big physical climate footprints, so closing the loop in climate risk in capital markets. And thirdly, that you should be considering and doing scenario analysis. What do different climate scenarios in terms of warming of the planet, in terms of different policy responses, mean for your strategy? Next slide, please. So I would argue that all of you as financial institutions should be approaching the TCFD recommendations with how can you disclose everything they are asking for, where it's relevant to your organization. The CDP disclosure platform is something that you can use to help you collect and structure the data for climate disclosure. It's fair to say that institutional investors are looking for more data on climate disclosure than is expected to be integrated into your mainstream report. Obviously, you don't put everything, all of your communications in a mainstream report. So we would recommend that you do use the CDP disclosure process to collect and structure your data, and then that you then integrate the important information into your mainstream report. And just as a bit of a plug, the Climate Disclosure Standards Board, which is a initiative housed in CDP, CDSB as we call it, runs something called the TCFD Hub. So if you put TCFD in Hub in Google, you'll find this straight away. There is a whole load of resources about what good disclosure looks like for in relation to the TCFD, and there's specifically a new e-learning course on governance of climate-related risks and opportunities in partnership with PwC and the World Economic Forum. And I know that there are inclusions from HSBC and others in that e-learning course to help you understand what good climate governance looks like of the company. Next slide, please. So I mentioned, and we've heard from Sarah, there are real trends towards climate disclosure becoming a mandatory requirement. And just a few of them listed here. In the EU, the Non-Financial Reporting Directive is the primary regulation requiring companies to report on environmental and social issues. That is being revised currently and strengthened. And it's very likely, I would say highly expected, that the EU will require TCFD aligned disclosure through that regulation. So that's something to watch as it develops. The UK has a green finance strategy, the UK government, and has set out an expectation that listed companies, large asset owners should be disclosing in line with the TCFD recommendations by 2022. Feels a way away, but as you know, that's only really one more or maybe two business cycles. Canada has been providing some COVID-19 loans and bailout funds for large businesses and institutional investors, and has made a requirement that anyone receiving those loans and bailout funds must commit to a TCFD disclosure. So kind of another way of driving this. And finally, Mark Carney, as he stepped down from the Bank of England, is now leading on behalf of the UK government the COP26 private finance agenda. COP26 is the UN climate change negotiations. They were due to happen this November in Glasgow, but have been postponed to 2021. And what Mark Carney is seeking to build is a whole set of regulators, policymakers, who will announce in November 2021 in Glasgow that they will make TCFD aligned reporting mandatory. So watch these developments. It's just very clear this is going towards a mandatory pathway. Exactly when, it's different in different jurisdictions, but this will be required of you at some point in the near future. Next slide, please. Now, as a financial institution, you know, often we say, well, we don't have a great set of emissions. You know, it's these heavy industry, oil and gas, electric utilities. In their operations, that's true. But as I said before, as a financial institution, it's really about how you are financing and enabling through equity investments, through your loan books, increased emissions or reduced emissions and other climate risks and opportunities. So last year, 295 financial institutions did disclose through CDP on climate change. This year, we launched a very specific questionnaire for financial services companies, which dives more into this issue of financed emissions and risks in the portfolio. A lot of information on the CDP website, but we rank those disclosures and a number of financial institutions receive an A from CDP listed on here. Lloyds, Citi, Morgan Stanley, HSBC and Barclays. We're not saying that those institutions are perfect, because they're not, but all of those represent really what good disclosure looks like. So if you want more information on what good disclosure looks like, you can look at the guidance and scoring on the CDP website, but also from our website, you can download those disclosures of those financial institutions to see how they are disclosing. Next slide, please. Finally, something I wanted to mention, this is really a call about disclosure, but disclosure is important, but all companies and institutional investors should also have targets. How will you reduce your impact on the climate problem and the growth of the Science-Based Targets Initiative, which CDP is a founding partner of and I sit on the board of? We have seen since 2015, when almost no companies had a science-based target, now some 970 companies committed to a science-based target. That is a target in line with the Paris Agreement, in line with what the science requires for you to have your portfolio, your operations to be operating within a safe boundary set by the science of well below 2 degrees and ideally 1.5. So there are already some 70 financial institutions, including HSBC, Allianz, AXA, and many others who've committed to set a science-based target. It's a challenge, it's a piece of work, but I would encourage you to also think about this as you think of how do you manage climate risk. One way is to ensure your operations and investments are changing to live within the science. Next slide, please. So the final slide, and really I hope helping to ask you some of the key questions. If I was a board member, I sit on some boards, but not of a large financial institution, I would ask my management, are we disclosing in accordance with the TCFD recommendations? It's a simple but fundamental question. An additional one I would obviously say is, are we disclosing through CDP with these 8,400 companies who are already doing so, are responding to the requests of our investors? Importantly, do we integrate those TCFD disclosures into our mainstream reporting? And yeah, that depends how you as the board and the management see how much climate risk is a risk to your institution, but it's certainly a question that should be asked because the TCFD recommends that integration. As a board, I think there are metrics and KPIs that you should have in place for knowing whether you're managing climate risk. What are the emissions from your operations? What are the emissions from your portfolio of investments and loan books? Are you incentivizing your management? Many companies, financial institutions now making variable remuneration bonuses partly about meeting climate targets. And finally, have we as an investment institution set a science-based target? And that was my timer for 15 minutes. So I've managed to do it on time. Over back to you, Daniel.
Paul, thank you. You could almost be German, and that's a compliment. So I think this is really, really helpful, and I can only speak for our own experience at HSBC. We started TCFD disclosure 3 years ago. When we started, we set out a very clear pathway that this is a 5-year journey. So we started with qualitative disclosure, went into exposures, and we're now at a stage of scenario analysis. And I can only recommend for everyone, it was very transformational for us because as soon as you include disclosure in your annual report and accounts, it goes through the governance. You build the muscle in the organization with audit committees, disclosure committees, third-party opinions. And with that, data gets to the quality where you need it. So for us, just starting it and signing up was probably the necessary step to then build the muscle in the organization to have the right information to report. So thank you, Paul. Meryam, you're the user of this information. You obviously look at this information for industrial companies as much as financial services firms, and I think it would be great to hear from you. What are your expectations and where do you see this going before we then open for questions? And again, for everyone, please put your questions into the chat and we'll pick them up after Meryam's presentation.
Thanks, Daniel, and hello, everyone. Thank you for the opportunity to speak. And first of all, I want to say that all this disclosure is not lost. It doesn't just stop at CDP, and I just want to reassure everybody that it really has consequences from that disclosure in a good way, and also perhaps in a way that you might not expect. So I want to give you a little bit of an idea of how we are using it. Just as a background, we are an asset manager globally, but based in London, but we also own by an insurance company, Legal & General. So I have two kind of aspects of being a financial institution as an insurer, obviously helping them, not directly, but by influencing them to actually commit to net zero themselves as an entity, which they have done, which is to align the balance sheet to 1.5-degree transition path to 2050. And then also as an asset manager, we have thousands of clients who want to address climate change, so helping them do that. So that's a key element of my job as a financial institution, to figure out what it means for us. So I am in your camp, basically. So there's that one part, sort of practicing what we preach and making sure that the way we do our business is aligned to the climate goals. But today I'm going to talk mainly about how we hold the investee companies accountable, and obviously in this particular conversation, financial institutions, which are banks and insurance companies. There are obviously other financial institutions as well. I think, as we heard at the beginning in terms of the legal implications, without kind of being sued per se, we can say that the financial institutions are heavily regulated industry. There are a lot of disclosure requirements and risk disclosures anyway as it stands, and so climate sort of comes on top of that. It should be weaved in perfectly, but it's not quite there yet. But one thing I could say, in having talked to many financial institutions, is that they're mostly worried about the regulations and the fact that the central banks are starting to use certain kind of scenarios against which to hold banks and insurance companies accountable for the risks that they may be sitting on that they don't realize. So that the regulatory part is moving very, very fast. And so that's something that I'm sure is on your radar, and it's not slowing down in terms of impact. Now, what I want to talk to you today mostly about is how we look at your institutions, how we assess you. And I think Paul's done a great job of giving you the kind of disclosure expectations. So I'm not going to go into the nitty-gritty detail, but I want to show you how we use that data as an investor. Now, in our case, we have an engagement program called Climate Impact Pledge, which is our overall commitment to engaging with investee companies across different sectors to help them transition into the net zero challenge. Now, we launched that in 2016, straight after Paris. TCFD was just announced, the framework wasn't in place. So we went ahead and started to come up with a framework which luckily looks almost like TCFD. So we've been kind of aligning in a sense, but I guess we all kind of look for similar kind of guidelines. So if I may go to the first page, lots of colors. This is just to give you what's happened in the last 4 years of engaging with banks and insurance companies, based on the criteria that we set 4 years ago. As I said, it's broadly in line with TCFD. It's really not that different. I mean, it's basically the same. Accountability is a governance. You've got risks and opportunity, scenario analysis, and then business plans are kind of what your strategy is. And that actually has the highest weight, because we look for your strategy first and foremost as a business, and then targets. So over the last 4 years, those two sectors have had a really good upward trend in terms of disclosure and standards. I know it's very small, but if you look at the little kind of years since 2017, the numbers have been going up. It sort of nets out, so don't worry that the number itself hasn't changed that much, but it's a really good positive trend. Why? Because it's TCFD, there's regulators talking about it. I mean, it's very obvious why generally the scores are going up. But if you were to just have a look at the kind of areas where those two sectors have done very well, let's just look at the banks very quickly. I think you can see the risks are really green, as you would expect, because you have to disclose it, and the risks are just what banks do. So they're very good at articulating risks. Although there are elements of risks that they don't talk about very well, like physical risks and so forth, which is difficult, to be fair. There's been quite a lot of good opportunities outlined in banks as well, sort of hundreds of billions being committed overall to finance the low carbon transition, for which they get a lot of positive scores. We kind of digging deeper into that, and sometimes you can't really find the details of how that, is that just business as usual, or is that really stimulating the economy? That's a difficult one for us to assess, but we obviously give scores to that. The scenario analysis has been, I think, a struggle for many institutions. And I want to say these are global companies, right? And sometimes for those of you who are in Europe, this is kind of name of the game. Everybody's talking about climate over in America or in Asia. This is quite new. The federal government isn't really on board with some of those ideas. It's much more difficult to put resources in that case. So you do start to see a bit of a transatlantic divide in disclosure, and then targets are still patchy. So you have certain targets for lending books, some parts of the business on green bonds, but nothing really holistic that we can speak of in banks. And moving over to the insurance side, I would say it's slightly behind, but that's partly because insurance also depends on whether you're reinsurance or life insurance or general insurance, or depending on the type of insurance business that you have. But again, risks are what they usually do very good at. There's been quite a lot of green investment opportunities that particularly reinsurance banks have, insurance companies have talked about. So they've had a lot of positive disclosures there, and I think they also struggle to have holistic views. And again, just coming back to my original point, is legal and general investment management is mainly a life insurance in terms of insurance. We also have other financial businesses, but traditionally it's been difficult to talk about impact on liability side of the business when it comes to climate change. And then what's really changed in the last 2 to 3 years is to kind of move away from liabilities into the investment side. I know that liability might be fine, it's a bit questionable because actually climate can have a lot of impacts on health as well. But in terms of the investments, all your fixed income exposures that you have in different sector, is that at risk? I think the conversations have moved finally onto the investment side of things, and they realize that actually I don't have disclosure in terms of risks from our mortgage books or from property investments and so forth. So I think many of us are just going through the process of understanding what it means to holistically look at climate change from an insurance perspective. So what we've done this year is to review where we are in terms of climate change engagement. We think we've had positive impacts. We like to think so, and we're not going to claim all that to be to our credit. A lot of investors, as you probably know, are engaged with banks and insurance companies, quite often also owned by banks and insurance companies. And so we felt that we wanted to up our game. Now we're talking about net zero challenge. And for those of you who don't know, so the net zero goes from just keeping temperature to 2 degrees or below above pre-industrial period to net zero by 2050, which is in line with the 1.5 degrees. It's a huge, huge challenge for all of us, and particularly for financial institutions, because you couldn't just shift capital when the capital requirements from a regulatory perspective doesn't allow us to do so. So we are very cognizant of the challenge that is on financial institutions to meaningfully shift business to align to net zero. But I think the ambition doesn't actually go away, because we have to finance this transition. We don't really have a choice, and we think there are great opportunities in really shifting away of what the opportunities are for us in this transitional period. So in line with that, we decided to up our challenge, and we'll be launching a new and improved engagement program. Well, it's not new, it's still going to be called Climate Impact Pledge, but it'll be announced in October. We'll be doing a lot more companies, a lot more sectors, holding those companies even more accountable as we ask them to sign up to net zero and to show meaningful disclosure that shows that there's a lot of internal thinking in terms of strategies. So I want to show you a couple of things in preparation to that launch. If I may go to the next slide. Okay, so this is just before I go into the details, sort of our commitment. And when I said at the beginning, look, the disclosure doesn't go nowhere. We actually use it. I just want to show you in a just very simple way, how your disclosure is starting to impact the way we invest. So you have your public disclosure, and when I say public, it's also CDP. Anything in the public domain that we disclose. We prefer it to be CDP because we don't really want every company disclosing in a different way, and CDP has great questions under which to actually compare and contrast different companies. So we collect this information, and then we have not only an ESG score, but we're currently creating a climate traffic light, which I'll show you in the next slide. It's provisional, so please don't share it to the public. And so what we want to do is we use this kind of disclosure over and above just carbon emissions data, which is sort of what we use normally today, to create investments whereby companies who are disclosing well on some of those metrics get overweighted in some of our investments and underweighted and so forth. This depends on the client take up on this kind of fund, but I'm just showing you just one example of how you disclose compared to your peers could have direct investment direct implications in the way that we invest on our equities and in bonds and so forth. But more directly, we'll be holding companies accountable through our voting. So we will be voting against companies for not disclosing, certainly. We talked about lack of disclosure. If you're not disclosing on CDP at all, strike out. We can't even have a conversation. So that's an implication there. But again, once you do disclose, if you're really not talking holistically about some of those implications or strategies, all that would start to be impacted in the way that we vote. And we also value our engagement. We recognize the challenges that you are under. As I said, from regulatory perspective, from business perspective, commercially, it's a very, very difficult thing to do. So we want to learn that and help you through the engagement. So many of you will be hearing from us and help you through this challenging period. But anyway, all this to say that disclosure and its implications would hopefully help you to disclose even more meaningfully, and then the market starts to price this in a lot more. So the companies who are doing the right thing will get valued for that effort. So that's our commitment, to look at the disclosure, to hold them accountable, and to action as an investor as well. So the next slide, which is the last slide, I don't have many slides today, is to show you, it's a little bit small, so I don't know if you can zoom in or not, but is to show you the kind of data points that we'll be using for the next stage of the climate engagement. On the left, the brighter yellow is the quantitative metrics that we'll be using for hundreds and hundreds of companies, and that's all sectors, so financials and other sectors as well. And on the right of it is more of a qualitative assessment that we'll be using, particularly for financials. Again, none of this is set in stone yet because we're just finalizing, but we just wanted to give you a little preview. So let me just go through the quantitative side of it. It's all aligned with TCFD, so don't worry, you don't have to learn this. If you did TCFD and if you did CDP disclosures, you'll be fine, because I'm sure you would not appreciate another framework. So governance is very important in terms of who's in charge, what kind of conversations are being had at the board level, who's accountable. Obviously, that's the most important thing. And your disclosure in itself also will have a score. In terms of strategy, we will be looking at your overall strategies, how much of that climate program will be impacting different parts of the business. Now, we also have a climate lobbying sector. Currently, we don't have metrics that allows us to hold financial companies accountable for the way that they lobby the governments on climate change. But I think that's going to change, because I know some people are looking into that. So if you are not pushing for green friendly regulations, then you might get a negative score there in the future. We also be looking at certain kind of policy that are specific to financials. There aren't that many that we can use for every company. But there is an indicator like credit and loan standards and responsible investment policies. So we'll be using this kind of scores from Sustainalytics. We also use what we call climate VAR, so how much your business might be at risk from climate change. Again, for financial institutions, it's not that reliable. As of today, just because, first of all, a lot of you don't really disclose scope 3 in a meaningful way for us to kind of make that judgment call. So this might not be used just for now in the financial sector, but we're definitely using that for many other sectors for which we can use carbon price and so forth to stress test some of the central scenarios. Green revenue is an important one. And again, it's very difficult for financial institutions, let's say banks, to talk about how much revenue you're getting from green. I'm sure it's not that high as a percentage, but it's a very interesting area, how much commercial interest that you're starting to get from green. And interesting enough, we get this indicator from HSBC. And so this is something that we really want to see going forward. You know, this cannot be just the risk and a negative story. Surely there's really good business to be had from this transition. The scenario analysis is also, I mean, we have tried to use some quantitative data here, but I would say the scenario analysis is quite difficult to assess from financial institutions. So I would use that with caution in that section. And then lastly, we're really looking for that ambitions. You know, are you signed up to net zero? How holistic is that? Again, we'll be looking at CDP for this kind of disclosure. An emission profile is just how much of your emissions, whether it be absolute or relative, is increasing or decreasing over time. So we'll be looking at trend analysis when it comes to emissions. It's not just a point in time analysis. So that's the quantitative side. As I said, that will be applied for hundreds of companies. All the companies will be traffic lighted on our website. So if you actually come to our website, come October, fingers crossed, you can look at how we scored you against each of those indicators. And that's again a commitment to be transparent and to show you how you are seen from an outside world. And so again, I'm hoping that this helps you disclose more, to compare against your peer group and so forth, and just continuously improve. So on the right, what you have is the more qualitative analysis, and that's when the engagement really comes in. For all our engagement, if you are a target company, because we couldn't obviously talk to every single company, we looked at your annual report, we looked at your CSR, sustainability, but everything that you disclose in the public domain. And so we continue to do that for those target companies and assess what kind of commitments you have, as I said, how comprehensive it is, how you articulate your strategy. You know, in the past, you've got your company strategies on one side, and you've got the kind of sustainability on the other. That's starting to merge now. So we want to see how much of that is embedded into the actual core element of your strategy. We'd like to see a lot more assessment around resilience, how resilient your business lines are as the world's change. There's kind of regional dynamics that are changing. There's a lot of physical risk analysis. If you heavily rely on revenue from certain sector, from your client base, that's that's something that I think that should all come through in the scenario analysis, but we're looking for evidence of that. Again, targets, 100 billion is not really enough. Like, how is those kind of targets that you're articulating will penetrate through to the way you do your business, and how we think you're going to be a success as a business on the back of that. And then collaboration, like, as I said, you got your Basel, you got your Solvency II, you got all those regulations, and a lot of the times you can't move, and that's fair, and we understand that. So we have to collaborate as a sector or a couple of sectors and sort of say, how do we meaningfully shift capital? How do we decarbonize portfolios so that we can do the right thing for climate, but as a business, so we're robust as well. So we're looking for good collaborative platforms to which so you can contribute constructively and to find solutions for the industry. And I think if you're in Europe, a lot of other entities outside of Europe are looking into that. And so we need to have that global knowledge sharing as well. So we're looking for evidence. And then lastly, red lines. And that's starting to increase. So obviously thermal coal, that's sort of a no-brainer in a lot of the companies. Not all, but, and then you have to start to see tar sands, some kind of Thai oil, and so forth and so forth. I think at some point you're going to have what is it that you wouldn't invest in because this is just not in line with 1.5 or 2 degrees even. Palm oil, some of the really devastating impact on forestry and so forth, food, agriculture, and really start to say that actually we do have a red line as a business, and as a result, this is the implication. So we are looking for that type of a red line as well. And I don't want to leave on a negative, so I'm just going to say that as a very last point, I do want a lot more opportunity stories coming out of financial sectors. And with the caveat that it's difficult, the world is looking to financial institutions to figure out how to finance this trillions of things that need to be invested in order to make this low carbon transition. And so to my earlier point about collaboration, we have to figure out what that financing mechanism looks like and what role each player would have in that is very important. So I want to leave that with you. I think that's a big ask for your board, but I would love that to be the conversation that you have. Thank you.
Thank you, Meryam. And if I may say, I mean, if you look at the page that is currently on screen, that almost is your questionnaire as a board you can ask, because those are the indicators that you would like to see as a board in your MI pack. I'll go to questions now. Again, I think we have a few really good ones already. If you have any further questions, put them in the chat. Stephanie, if you take the presentation off screen, I think we can see people easier. And I'll start with one that came from Rock Sanford, which really is a question. We talk about net zero all the time. What's the standard? What are we using? Against what's net zero are we holding ourselves accountable? I think that's a question probably for all three of you. Paul, maybe I'll start with you because of your science-based target exposure.
No, happy to start. Thanks, Daniel. I mean, this is still evolving. You know, there are carbon budgets and benchmarks. The IEA, International Energy Agency, has a 2 degree and is developing a 1.5 scenario. And generally, they are used a lot by industry, and almost everything else is built off the IEA's work. And then the IEA isn't perfect. Science-Based Targets Initiative does have sectoral decarbonisation methodology. So for each sector, how emissions should be declining to that net zero by 2050, because it's different for different sectors. Two other things to mention, certainly for the oil and gas and fossil fuel sectors, Carbon Tracker, another NGO that does some excellent research, has some very good carbon budget analysis. And if you're in the UK government has a carbon budget. So you can just, you can use that. So it's not a definitive answer, but I would certainly start with those references.
Sarah, anything from your side?
I'll just make an observation on what net zero is not. It's been really interesting in the last 12 to 18 months when we actually have had the net zero laws starting to be embedded in certain jurisdictions like the EU and the UK and New Zealand. And it's really brought home, I think, to industrial companies in particular, that you cannot interpret net zero as just scope 1 and 2. There is no point interpreting net zero as something that is within your operational boundaries and drawing an artificial distinction between whatever else happens upstream or downstream in particular. Because if you're looking at a situation now where jurisdictions are legislating for the entire economy to be operating on a net zero basis, you really need to start looking at it holistically across the entire value chain.
Thank you. I think a second set of questions around how do we actually, as a board, use disclosure in a better way, right? I think there was a fear expressed that there is a lot of information out there and every board gets hundreds of pages of packs. How do we actually use better disclosure to drive decision-making, drive engagement within the boardroom and with the management team? Do any of you have any experiences, any guidance for the members? Maybe Karina, I can also ask you, because you are on the board of a large energy company and you're using this.
Yeah, I mean, I have a lot of sympathy with that question because I have seen, I mean, sorry, Paul, but it's possible to get a really high grade with CDP by basically ticking every box and jumping through every hoop and being extremely thorough and transparent, but not necessarily doing what Sarah just described, which is shifting your business so that it aligns with 1.5, which, you know, you don't align with a temperature number, but you align with a volume of emissions. You translate that temperature into a carbon budget that you then attribute to your own company, which is the science-based targets. And then you work up a plan that says we are here today and we have to get here, like there in 10 years, there in 20, and there in 30. And so that's the part that is often sort of drowned out of the disclosure, because the frameworks do allow companies to weasel through and just do a lot on process and a lot on transparency and not necessarily a lot on results. So I think people like Meryam, people like, people who are filing litigation claims are going to be very shrewd about the quality of disclosure, not just the volume. And we in boardrooms need to be alert to that. It starts with being open and transparent, but we have to, the substance has to be there, and there has to be evidence of change.
Maybe I'll just build on that. I mean, Karina said it was, if we just evaluate disclosure, you're right. We've evolved to evaluate also performance, and boards should be evaluating performance. I think, you know, with TCFD and with CDP is completely aligned with the TCFD. It's kind of one and the same to some extent. The data that's being collected, you must have the metrics and the targets. The TCFD requires them, recommends them, and the board should have metrics and targets. How are your investments reducing emissions? That is a really challenging question, but you have to be able to show that. I also think you can now do a temperature rating for your portfolio. GPIF, the Japanese pension fund, had a consultant help them, and they published that their portfolio is on a 3.1 degree centigrade warming pathway. Because they're such a large investor, a universal investor, they own a slice of the world economy. At CDP, we now have a tool called Tropic, where you can analyze 4,000 companies and do a temperature rating of your portfolio, of your loan. But and there are other tools, and we're not the only people to have these tools. But as a board, you need to have these targets to hold management accountable. And I would also encourage you to have targets. The management need to meet those targets if they want to get their full set of incentives, financial incentives, because that is really what drives change. You know that as a board. And you need to include those on climate.
Can I come in on the target? So one of the other, I mean, we've seen loads of trends and changes over the last, not just 4 years, but over the years that I've been engaging with companies. Targets used to be set by companies deciding what they want to achieve. And the biggest shift is that we went from that to no. This is the path we want to be on this planet. So look at science-based target, look at net zero, and that's what's really changing the mind, because you can play a lot with just kind of fiddling with absolute and relative, you know, and that's what we've been seeing with a lot of companies. So I know it's not, you know, it's not that easy to set target, but in terms of figuring it out, what decarbonizing balance sheet looks like for a bank, what decarbonizing, you know, insurance investments look like, that's something that I think we need to start to increasingly use central scenarios together. And that's what's starting to happen in terms of central scenarios of the pathways, and then align your investments against them and go, okay, I've got too much of the sectors or too much of the regions or whatever it might be. So again, my earlier point about collaboration becomes more important because it's not up to you anymore.
Sorry, I was suddenly put on mute. So there was a related question whether we should consider setting up a climate change subcommittee of the board. Clearly, this is a specialist topic. This is difficult. This is detailed. At the same time, it is so important that the main board probably wants to know and should know about this. So any experiences, any guidance for the members?
I don't think there's a hard and fast rule. It's dependent on the nature of the company and their structure. If we're looking at banks and insurance companies, I think you're absolutely right, Daniel. It is such a fundamental strategic risk that requires strategic input from the full board, that it is very difficult to be able to delegate it to a subcommittee who merely reports to the full board but is responsible for making the decisions. I think it certainly is something that ultimately needs to be made clear that is within the purview of the decision making of the entire board. Even if there is a subcommittee doing a bit of the heavy lifting, I think it still needs to be considered by the full board.
I'm going to take the complete opposite view, if I may, Sarah, which is that by definition, anything a committee does has to go up to the board. The rest of the board has to engage with the recommendations of that committee and has to take responsibility for the ultimate decision. However, the nature of board meetings, particularly for large complex companies, is that the agendas are systematically overcrowded, and there simply isn't the bandwidth to consider climate change with the time and the resources and the expertise that needs to be developed by the individual directors who are looking at it. So I'm a big believer, and I say this from personal experience of having been on it's an oil company board, but the complexity and the scale of the challenge is, I think, entirely comparable to that of a bank or an insurance company. It wasn't until it was moved into a committee, and it's not called the Climate Change Committee, by the way, but it is a committee that owns it. And it could be the audit committee, it could be the governance committee, it could be whatever committee. But I think it needs to be a committee that has the time, the bandwidth, the people. The people are going to undergo significant training with proper experts who come in, and that committee will dig into the issues in great depth, report back to the whole board, bring the whole board into some of the committee meetings when there's an important training exercise to be done. But personally, I've found in all my boards that the main board meetings are just desperately overcrowded, and it's only in committees that we get to real work. So I'm a fan of committees. It doesn't have to be called climate, but I think the only way it really gets dealt with effectively is when it's handed to a smaller group who then, which by the way, I chair the sustainability committee in my oil board, and we are constantly being gate crashed by other board directors who want to attend our meeting because it's the coolest committee on the board. But and everything does get brought back to the board, but that's where we have the time to look at the issues.
Yeah. To me, from a governance point of view, it's really akin now to occupational health and safety and work health and safety, insofar as the heavy lifting is done at committee level, but it's non-delegable. At the end of the day, the full board needs to be taking the ownership and responsibility. So I think you're absolutely right. It's so detailed that you're going to need to delegate some of the heavy lifting. But at the end of the day, we don't want the situation where, as does often happen, the rest of the board thinks, okay, well, that's the sustainability committee has looked at it and we don't engage with it. Yeah.
Exactly right.
I agree with what's been said. And I think it must be integrated also into the other committees. If you have a risk committee, a compliance committee, a strategy committee, it must in some form, and I imagine that other speakers would agree, but because, I didn't mention this in my presentation, but the Bank of England and the potential regulatory authority here in the UK is bringing in new requirements for banks to do, simple terms, stress testing on climate change and collect more disclosure from their loan book. I'm sure Daniel knows about that. That's coming in 2021, but you need to be planning. So that should be in the compliance committee. Are we going to be able to comply with this new requirement? This is such a complex, evolving topic. I can see having a specialist committee, but making sure it's integrated, and certainly, as others have said, it's the board's responsibility.
Agreed.
Yeah. I can only say for ourselves, so we took a lot of effort to train the main board because we didn't want to get into a situation where this is delegated to the 3 people that already believe in this and have an understanding. But actually, it is a topic where the entire board has the ability to ask the right questions. I have, I think, time for 1 or 2 more questions. One topic that came up in the chat is, how should financial institutions think about long-term investments in, especially the oil and gas and other carbon-intensive sectors? Maybe Meryam, I could come to you with this. You talked about the red lines, which I think are topics that many people are aware of: thermal coal, extreme oils. Then you have obviously many of the big mining sectors, the steel sector, obviously the oil and gas and the utility sector, where we are all still continuing to invest and finance, knowing that a transition needs to happen. How do we manage that pathway?
Yeah, I mean, it is a difficult one. I think looking at those kind of central scenarios and how different sectors, commodities, businesses will be impacted, it is an important one, because you don't want to be the last one holding those assets. I think there's a balance to be struck here in that many companies will transition. And I think it's important as an investor that you help them transition in that path. For that, we say disclosure, but this isn't really about disclosure. This is about commitment. We trying to understand where the company is going. And if that narrative is plausible, then yeah, you keep investing in it and help them. If the narrative isn't there, the commitment isn't there, that's a risk. And that's when you have to take your action as an investor. So I think you have to do both of those things. And so I showed you the disclosure requirements, but what we're showing is companies that might be sitting on the risk that they're not quite realized by the market today. And as I said, we can make investment decisions already. Now, when it comes to something like commodities, or let's say cement, which is extremely hard to decarbonize, you have to make a call about the transition path. What's going to happen in 5-10 years time? We're still going to need cement. We're going to have to figure out a way to decarbonize that hard to abate sector, and then make a decision accordingly. Or you might say, well, actually, we can really make electricity without thermal coal now in many, many markets. I don't want to be sitting on this for too long. So the question of alternatives, the question of policy support, all of that will come in. And to be honest, that's what financial sectors are very good at. And so do rely on the expertise to do that. But don't hold on just because you looked at your past performance. Do look at the forward-looking scenarios, resilience, adaptation. Do you want to be holding on to this for 10 years? Is that the best thing to do for your clients? I think that's the conversation. Whatever the committee sets up has to be mandating of their managers to do that.
Thank you. And I think there are a number of questions today about scenario analysis. Good news, our next session here at Chapter Zero is around scenario analysis. So please tune in. We will also make sure we will share more information about what are reliable scenarios and how to run a scenario analysis stress test. We also have somebody from the Bank of England join us next time to think about and discuss what the regulator expects from us when they think about a stress test. Karina, can I hand it back to you? And before I do, I just want to say thank you to all of the speakers. And Karina, please, your closing remarks.
Yes, thank you very much. I thought this was really terrific. Just a quick bird's eye. Rising incidence of litigation across jurisdictions, not just the US, where everyone expects it to happen, and directors are in the firing line, as well as in financial institutions and others. But we as directors must be mindful of that. And we will be exposed for poor disclosure. And I thought the connection between the litigation risk and the rising expectations of disclosure and the quality of disclosure that is required, not just disclosure for the sake of disclosure, was very important. So bottom line, the bar keeps rising for directors. And I was struck by the definition of what is acceptable for a director. What's acceptable is best, or what is a reasonable director in law is not the average, it's the best practice. And so all of us, and that's why Chapter Zero was created, have a duty to achieve that standard of best practice. Hearing from CDP, what really stayed with me was $106 trillion. For all of you who sit in boardrooms and who look at your shareholder structure and look at who your largest investors are, and we all turn around and say, okay, there's BlackRock, there's Legal & General Investment Management, there's Vanguard, there's State Street, those are the biggies. And if they hold us, we need to listen to what they say. But, BlackRock is $7 trillion. We're talking $106 trillion of assets that have backed the CDP. That's a number that should grab everyone's attention. the 36-fold increase in climate disclosure, the fact that half of companies by market capitalization are now doing this, we have definitely passed the tipping point. If we're not doing this, we had better hurry up and do it well. And I thought Paul did a great job of laying out a bunch of questions that we can all take back to our boards. Are we doing TCFD? Are we doing CDP? Are we integrating this with our financial reporting? Are we tying it into executive pay? Big one. And going back to the point about this needs to be integrated in every key committee. The remuneration committee has to get wise to what these issues are. And are we ready to set science-based targets? Speaking from someone who serves in the oil sector, I can tell you that we have to hold our breath and figure out whether we can actually take the leap, but it has to be done. I was very impressed with Meryam's model of engaging with customers. And I thought that that was such a great model to emulate for all of the directors in this room who serve on banks and insurers, because the whole point is we don't have the luxury of walking away from clients. We can't just fire clients because they're in activities that are high risk. We do have to at least give them the benefit of the doubt and work with them and guide them, exactly as LGIM is doing right now with its investee companies. So I thought I want to just photograph that table and just copy paste everything that you do, Meryam. If I were serving on a bank board or insurance board, I would want to apply that to my underwriting clients, to my financing clients, in a very similar way, obviously adapted to the specifics of each business. But I thought a very useful model for assisting clients, because ultimately when you've got a long legacy of clients, you don't want to sack them. On the other hand, there are those red lines. I operate in an industry that is on the wrong side of those red lines for many investors. We certainly value investors who are prepared to bet on our transforming ourselves. So we want people like LGIM to work with us and stay with us as we transform ourselves. But if they threaten to pull their money from our peers for failing to move, that is part of the mosaic of actions that need to happen out there. There are some, as Meryam very aptly put it, there are some activities that are incompatible not only with the 1.5 degree scenario, which is what we should all be striving for, but even a 2 degree scenario, which causes 40 million people to be displaced and at risk for their lives. So coal is not viable in a 2 degree world, or even in a 1.5 degree world, or even a 2 degree world. Tar sands, I say this, there are a number of industries that are going to be stranded, and we can look at it from a moral perspective, or we can look at it from a commercial perspective. Do we want to be left holding these assets when they are underwater? That is the question. And it goes back to the litigation issue. We will not be able to argue 10 years from now as directors, oh, we didn't know, because we know. The information is everywhere, and you heard it here today. Thank you very much.
Thanks, everyone.